Welcome in, and thank you for joining us for another episode of Healthy, Wealthy, and Wise Retirement. Your host, Lauren Sherman, is a certified financial planner and owner of the flat fee firm Integrity Wealth Management. He curates each episode with you in mind. Whether a work-optional lifestyle is on the horizon or you're already there, this show has something for you. With that, listen in, and I hope you enjoy the show.
Welcome in to another Healthy, Wealthy, and Wise. I'm your host, Lauren Sherman, and today we're doing a little bit of an impromptu podcast. I thought it would be helpful to, I just got done with a couple of meetings this morning and thought I would share a couple of my thoughts as it's been a little while since I have put out a new podcast. I have a topic coming up where we're going to talk about, interview an industry expert about tax law changes and legislation outlook, but I thought it would be helpful just to talk through a couple of things that are top of mind right now. So the first part of this podcast, I thought I would cover a little bit about the role of an advisor, and maybe specifically from the standpoint of kind of what I would refer to as like a yes man or an order taker, just executing what a client requests versus maybe the role that an advisor, in my opinion, should be doing. So we'll talk through that a little bit. That's come up in a couple of conversations. And then I also want to talk about and share, I'll share my screen actually for anybody watching this on YouTube as I talk through the retirement risks analysis process that we go through. I think I've mentioned this in past episodes a little bit here and there, but seeing the visual might be helpful for people who are on the fence about whether or not they want to go through this process or get a second opinion review of their portfolio. And hopefully that will be helpful for you as well. So let's jump in. To start with, the conversation about kind of the role of the advisor has been an interesting one lately, because I think, you know, Integrity Wealth Management, we have a flat fee process, pricing model. We have a comprehensive process where we're doing in-depth financial planning, not solely investment management, but we're doing a lot of in-depth financial planning in addition to the investment management. So, but what often comes up, you know, I think where I was going with that is that we often are attracting people with higher net worth. I think on our website, I may say that I think it lists out some characteristics of people that we typically work with. Most of the time, people tend to have roughly $2 million or more of investable assets. Lately, we've been having conversations with most people tend to have somewhere in the ballpark of 5 to 25 million, somewhere in that range. And they have a little bit more complex of situations, you could say, potentially a little bit more financial savvy than your typical professional who might be in a different field altogether, or just from the standpoint that they may be a little bit more analytical minded and almost like a hybrid do-it-yourselfer, where they're thinking, okay, maybe I could do this on my own, but there's probably some parts where I'm going to lose some efficiencies, or potentially I have a few different blind spots that are not on my radar. And, you know, I'm always impressed when people have the self wherewithal to acknowledge some of that and still seek out a financial planning relationship, even though they're pretty darn financial savvy themselves. And frankly, some people just don't want to do it on their own and spend all that time in their retirement hours managing the portfolio when they could be delegating it. So I think where I was going with that is that often when people do have a little bit of the financial wherewithal, they're a little bit more financial savvy, let's say, they have a really good idea of what they want retirement to look like, or maybe more specifically what they want the portfolio to look like. They maybe have strong inclinations of, I have a strong belief in this or that or this market. Maybe I want to overweight in this sector, let's call it. So there's a lot of that we hear just because, and and I appreciate it. Frankly, people have strong convictions of what retirement assets will perform best for them. And I think when I mentioned before, I think the challenge as an advisor is that some advisors almost kind of trip over themselves to take on new clients. And I can kind of poke fun at this because that was probably me 20 years ago when anybody and everybody looks like they, from my perspective, should become your client. And you kind of appease them by saying yes to everything. And that's where I refer to like that yes man mentality, or kind of an order taker, just executing the trades or decisions that clients make. And I think that's maybe not particularly helpful of a relationship where the advisor's role is to be the expert in the room. And if there's two experts in the room, great. Let's have those conversations. But as the advisor, it's our job for our team to push back when we see inefficiencies or a better way to do it, or just sometimes people get too bullish or bearish or to have too strong of convictions one way or another. And it's okay to have strong convictions, but I think it's also wise to kind of play the alternative perspective and, I guess kind of look at both sides of the coin, I guess is an easy way of saying that. So that's one thing, just thought was a top of mind thought. And it's our job as the advisor to make sure that there's not blind spots that are going to come up and derail a retirement plan or even a plan for those in their working years still. Because often what can get us in trouble, it's not always the known, it's that, I think we don't know what we don't know sort of box of what falls into that category is what sometimes can derail a person's retirement, particularly if they're trying to do it on their own. And maybe they were very, very proficient in what they were doing professionally, but their profession was not that of a financial advisor where you have the background designations and so forth like that, or the tax background and so forth. So those are some initial kind of big picture thoughts. That's a little bit of a kind of specific thought to have, but I thought it was helpful. We do have, I'm going to share my screen here. If I remember how to do this, I'm not using Zoom right at the moment, but we do actually have something that we send out to clients where we can have, let's see. There we go. Where we will have them actually sign this ahead of time. And just to acknowledge it, I think is really helpful to go through the expectations of what the relationship's going to look like, both from the client perspective and from the advisor perspective. So I've always found this interesting to talk through because sometimes it surprises people a little bit about the different things that we do. And just as surprising can be maybe what we do not do, which I think traditionally people would think that it's the advisor's job to outperform the market. And that's kind of where it starts and stops in the relationship. And from my vantage point, that's kind of the least of things. That's not really what we're trying to accomplish. We're trying to optimize portfolios and things like that, of that nature, from a tax perspective, from an asset location perspective, from an income planning, estate planning, insurance reviews. There's all sorts of things that go into it. But as far as trying to time the market or outperform the market based on bold convictions, I think that's where sometimes knowing a little can get you really into trouble. It's kind of that learning curve. Sometimes it's ironic, but sometimes we're in our best spots or we can get into the least amount of trouble when we know a whole lot about a topic or virtually nothing. And when we get in the middle of knowing just enough to be dangerous, sometimes that can be dangerous for people's portfolios. I've certainly seen that many times in the past when I've done reviews. So we go through this with people of what to expect, conversely, what not to expect, and then some expectations that we have from the client's side of things too. of mostly just being fully transparent with us, inputting data when asked, syncing things, offering open and honest feedback. I have one listed here that I sometimes get pushback, introduce others who may benefit from our help. Certainly not a requirement, but we just kind of ask people to be mindful of that, as that's how we meet a lot of our future clients, is through our current client relationships. But yeah, that was top of mind, of just talking through a little bit about the role of the advisor. That was not meant to be a fully comprehensive list by any means, but just top of mind specifically with that mentality of when we get into some of those higher net worths. I've had conversations, and when we've onboarded a few clients that have, well over $10 million of investable assets, and it's our job to sometimes push back a little bit and have some of those tougher conversations. And I think that relationship is so much more healthy than having one in which the advisor is just processing and executing what the client is kind of giving orders or making decisions on their own. So those are a couple of thoughts on that. Let's pivot to this retirement risks analysis, which I think I've highlighted a little bit in the past, but most of our clients at their net worth, quite frequently, they are coming to us with an advisor relationship already in place. So they're typically kind of graduating, is the way I refer to it as, from their current advisory relationship. Maybe they started that advisory relationship where they didn't have a whole lot of assets, or it was kind of convenient at the time. Maybe they didn't know as much as they know now, and they just got into that relationship because it was easy or recommended from a friend. And quite often, once their wealth gets to be a little more substantial, they're looking into private wealth options. They're looking at more in-depth financial planning, estate planning, particularly tax planning is one that most firms have to stay an arm's length away from, just from a compliance standpoint. So we get pretty in-depth with that stuff, and often people are not receiving that from their current relationships. But so I say all that to say this is where we start. Rather than giving people a 50-page report where they're going to just be overwhelmed with a bunch of stuff, we like to start with what I've coined the retirement risks analysis. We've been doing this for 10 years now. And it's reviewing the 15 biggest risks in everybody's retirement. So the risks are the same regardless of who you are in your situation. What's going to change is whether the risks are highlighted red, green, or yellow. And green being that there are very little improvements needed in that area, still meaning that we're not going to just avoid that. If you become a client, we're going to continually manage that risk, but it doesn't mean that it's just not a immediate concern at this time. Yellow comes back meaning that there are some improvements that can be made, and red would mean there are more considerable improvements to be made. And at the heart of this, it's helping people essentially define, the biggest question a lot of people have, I guess, how long is my money going to last, and how much of it can I spend in retirement? That question is kind of the same whether you have 1 million or 10 million, because clients that I've spoke with that have $10 million, they're not spending on the same budget that someone who has $1 million. So they're just kind of living to their means. And that risk of potentially outliving their funds is still a very real risk that they want to avoid or minimize as much as they possibly can. And then, as I alluded to, the other component here is how to avoid anything that could potentially derail the planning. Essentially, those blind spots and kind of that bucket of, or that quadrant of like, we don't know what we don't know. So this is a really helpful review for people. Obviously, if you already have an advisor, that's most frequently how people are coming to us. But even if you don't, I guess it would be helpful in either scenario. And even though it's called retirement risks analysis, it's really beneficial to do at any age. We've had clients, I've kind of found it funny that some of our clients have trended younger and younger and with greater and greater wealth. It used to be, a handful of years ago, everybody that was becoming clients were 65 and older, and they accumulated their wealth over many, many years of working. And now we're working sometimes with younger and younger folks that have accumulated upwards of 10 million plus. So it's very impressive from their standpoint, but also means that they have a longer runway where things need to go right, and we don't want things to go wrong. We have more years to plan for. So kind of the planning even gets elevated a little bit when you have a longer runway like that. So back to this, the retirement risk analysis. The first page shows all 15 different risks on here. And as I scroll down a little bit, people chuckle when they see that last one. The self-sabotage risk comes into play often when we kind of get in our own way, and we can be our own worst enemy. Also, from the standpoint, unfortunately, that can become an issue even when people have a financial advisor, because maybe their advisor is not a fiduciary. Maybe they're selling them funds or proprietary funds that are kind of lining their pockets, and maybe not to the client's best interest. And unfortunately, that self-sabotage risk can seep into even advisory relationships sometimes. But I just mentioned that one off the top because anytime I show this, that one kind of gets a chuckle right out of the gate. But essentially, the first page can be a little overwhelming because there's a lot of color on this. But it's a heck of a lot better than a 50-page report full of financial jargon. So even if, say, you're married and your spouse is not particularly interested in finances, we can help both people get engaged with the process by, you can really quickly glance at this and get an idea where your plan's strengths and weaknesses are at without, everyone can look at a color-coordinated page without fully understanding finance terms and jargon, and still have an idea if you're on the right track. So the first one, we just are highlighting what needs what needs improvement and what does not, and kind of the level of importance. And then page 2, this was actually one that we did for an actual client quite a while back. This is real data. We just removed the names from it. And page 2 I like because we're kind of getting rid of everything that was green on that first page. We're probably getting rid of a few of the yellow risk, and we're really highlighting just what's most important here and focusing on those, because that's where we're really going to improve the planning. And one thing to consider is, let's say, I just did a client meeting where they had accumulated over $10 million in assets, and you would think they would have a clean board here of all green risks. And we had 11 risks that were highlighted on their page. So it's not just about how much wealth you have, but they had 11 risks highlighted. And I think that can be frustrating because it's like, gosh, we've done so much right by saving and investing over all these years, and we still came back with a lot of color on our plan. But I think it's important to realize that does not take 11 individual solutions to address all of those. Often we can move a few levers and tweak a few things and solve, sometimes 3 or 4 risks just with one solution. So something definitely not to be overwhelmed with. And when we do these reviews, just to kind of take a step back too, I've always done this just as a complimentary service. People haven't taken advantage of it. I mean, in a bad way, taken advantage of us with this, because I think the reason is they don't just take the assessment and there's no chance of them ever becoming a client. They're not interested at all. We don't really run into that problem because they have to do a lot of work on their end as well. So this is not something where, they have to roll up their sleeves and get a lot done on their end too, just as we are rolling up our sleeves and doing a lot of work on our end. They're having to take assessments and things of that nature. So we've never charged for this. It's a complimentary service, and the reason for that is it's helping us determine if there's a good mutual fit. So it's kind of them interviewing us and us interviewing them, so to speak, where they're getting to know our process. We're getting to know what it's like to communicate with them throughout the process. So it's a little bit of a get to know you process where we're turning the typical relationship, or I guess the standard way of doing things with a traditional advisory firm might be you get a high level overview of who they are, and then you slide the paper forward and you're asked to sign on the dotted line. And instead, we like to flip that on its head and get to know each other better and get to know where we could potentially specifically improve your situation before we engage in the relationship, so that we have some actionable things to point to, rather than just kind of hypothetically speaking about everything. So that's a little bit of the background. So long story short, this is something that you can take with you and implement on your own if we don't turn out to be the right fit. So what I like about page 2 also is that it gets into a little bit more specifics of the situation, and then it offers a real brief high-level solution for each one of these as I kind of scroll through them. So it, if it is something where, you know, you can at least see which directionally that we're going with the solutions, and if that aligns with your values and philosophy, and if not, then maybe there's a conversation to be had before the financial advisor relationship happens. So essentially what this really helps us avoid is we're not having clients become clients and then they're just with us for 6 months and then they're out the door because they realize it wasn't a great fit. This is a way to help at least determine that hopefully it's going to be a long-term relationship. So I kind of zipped through some of that, but let me stop the screen share here. Hopefully that was helpful. I think at the end of the day, everybody, you know, situations change so frequently that having a review is certainly not a bad thing. So if anything else, it will help you identify some possible areas that could use a little bit of improvement. And as I keep referencing, a lot of times those fall into that category of the stuff we don't know that we should have even been looking into in the first place. So that's a quick review of that. There's a lot of technology behind the scenes that goes into that. So the output kind of makes it look a little bit simple. But in order to get to that point, we're having clients upload their tax return, their investment statements. We're having them take a couple of different assessments. One would be a risk assessment. Another would be a retirement style assessment that has some really interesting output so that we can mold a strategy specific to you instead of kind of the proverbial square peg into a round hole, I think is unfortunately the approach a lot of advisors take, where they have their convictions and their investment strategy and their retirement income strategy, and they're just kind of fitting all clients into that, whether that's the dominant values and characteristics of the clients themselves or not. So, yeah, I wanted to zip through this fast, and I think it felt like I talked through that pretty quickly. So maybe at some point I will do a more in-depth review of this and some of the technology that we use behind the scenes, how we're reviewing also private credit, how that can, or private wealth, I should say, how that can be a valuable component of the portfolio. So there's a lot that goes into that, and the final output makes it look rather simple. But for all of those people who are more detail oriented and like to get under the hood and really dig into how did you arrive at these conclusions, we can share all of the behind the, kind of under the hood stuff too. So I think that's all I have for you today. Let me pop back into sharing my screen here. If you're on YouTube watching, you can go to integrityguidance.com, and if you click on the podcast tab, let me do that really quickly here. So on our homepage here, for transparency purposes, we try to lay out everything as far as like our fee structure, the services that we offer, Our team is all listed there. So we put a lot of that available here. It talks through our process, some of the problems that we help solve. If you scroll down, it'll tell some of the type of people that we best serve. And also if we're not a good match, we don't have any direct relationship or affiliation with these companies, but these are some that I feel fairly confident in that are worth checking out if we're not the right fit. But integrityguidance.com, click on podcast, and you can access all of our past episodes, or you can go to wherever you get your podcasts, Apple, Spotify, things of that nature, and you can find us there as well. So hopefully this was helpful. I feel like I've been talking a million miles an hour, but I wanted to get through this in a timely fashion, and maybe we overdid it a little bit, but hey, this was an impromptu one. So at the end of the day, hopefully it was still helpful. So I will be coming back with that episode a little bit on the BBB, the Big Beautiful Bill Act, some tax law, some legislation outlook, and things of that. Sometimes it's not a bad idea to circle back and kind of pause and reflect on things like that bill, so that, the dust has settled a little bit versus trying to be the first out and have the first opinion on it. So I'm looking forward to having that conversation with Becky Swansberg, but that is yet to come. So stay tuned. I maybe shouldn't say come back in another 2 weeks, because we've been doing a lot of client reviews, and that's been, at the end of the day, the client activities always are priority number one, and the podcast is further down that list. But I'll try my best to do a little bit better job of staying on top of that and not going weeks and weeks at least without having a new one come out. So, but until then, God bless, and hope you come back for the next episode.
Thank you for listening in and supporting this show. And if you have a moment, we'd love a 5-star review to help this podcast reach even more listeners. Also, this show thrives on feedback from its audience. So if you have any topics you'd like to hear covered, or have anyone specific you'd like to see join the show, please email your recommendations to our address, hello@integrityguidance.com. That's hello@integrityguidance.com. We review every email that comes in, and we will do our best to include any recommendations you have for us. Thanks again, and be sure to follow our show so you don't miss an episode. This podcast is for entertainment and informational purposes only, and is not intended as specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and owner of Integrity Wealth Management, a flat fee firm which serves pre-retirees and retirees in search of their own work optional lifestyle.